Morning. Never a dull moment in the markets. This last month, we've had winter is coming in the north. We've got to discuss the US elections, a lot of uncertainty there. And looking locally, a lot of people are wondering whether South Africa is a failed state. So a lot to get through today. Yeah, a lot of excitement, a lot of volatility in the markets, as has been for the last 9 months. And it doesn't look like the end of the year is going to get any quieter. But before we get into that, just a quick look at the surveys, just to show that the Sygnia funds continue to perform well in the low return, high volatility environment, with the funds from low risk up to high risk, 1 year, 3 year, 5 years, 7 years, and 10 years, all the way out, either first or second in the various categories. Looking within the best investment view, nice positive absolute return number from the Signature 70 fund, up 7% over 1 year, nice 11% ahead of the bottom in that category. Still a lot of volatility amongst the various constituents of that index. Looking at the single managers, again, 7%, nicely up ahead of -2, the bottom performer, along with the single managers, only forward ahead of the Signature funds over 1 year. 3 years, number 2, 7 and 10 years sitting comfortably at number 1. But let's get into the market update. Poor old Fauci. So the relationship between Trump and Fauci seems to personify the world around and the confusion about COVID. Trump once again attacked Fauci, saying people are tired of hearing Fauci and all these idiots. Fauci responded in true Godfather style by saying, nothing is personal, it's strictly business. And we all know what that meant in the Godfather. But to be fair, the confusion is at all levels, whether it's safe, whether it's not safe, whether to have lockdowns, whether to not have lockdowns. And even though we're rapidly approaching the end of 2020, this confusion still seems to exist a lot. And this month has been no exception. In fact, markets are down 5–6% in October as a result of concerns about a second wave. Winter is coming in the north, and with that, UK, Germany, and France have all imposed strict 1-month lockdowns, mostly on leisure activities, but it has spooked the market, and markets fell on concerns that growth is not going to be there. Particularly in the leisure sector, with restaurants being closed and bars, alcohol companies came off, a lot of concern. However, we still are confident in our belief that this is not going to disrupt markets. It's not going to disrupt economic growth. There may be a small tick down from the acceleration we've seen, but we're certainly not going to go into a double-dip recession. It's going to be, if anything, the double-dip growth. If you look at the top chart, you'll see there the blue represents the previous peak and the first wave that we had with COVID-19, and the green is the current wave. On the horizontal axis is the number of new cases, and on the vertical axis is the number of deaths. And you can see here, look, for example, the UK in the previous wave versus now in the second wave, a far less lethal wave, and also putting far less pressure on hospitals. And that's the important thing, because hospitals, lockdowns are designed to protect the hospitals, to protect the healthcare system, to spread out that burden. And we're not seeing an increase in the burden. Even in the first wave, when things were really bad, that the modeling suggested that hospitals would be used up to 5 times as much as they were. And now we're seeing hospital usage, again, 1/3 to 1/4 of what it was in the first wave. So the pressure seems to be manageable. And the result, if you look at the bottom chart here, you can see a slight uptick in the stringency. This is reduction in your mobility. France, slight uptick there. UK, slight uptick, but nowhere near what we were seeing in April. So that again gives us confidence that there is no need for a stringent lockdown. The lockdowns that are taking place are while they're countrywide, They are far more focused. It's very much on leisure activities. It's very much on social distancing. So people are still at work, the economies are still moving, transport's still happening, and the impact on growth is completely insignificant compared to what it was in April. At the same time, we've got vaccines to look forward to. There was unfortunately some bad news from Johnson & Johnson and Eli Lilly, who both paused their clinical trials. But at the same time, AstraZeneca Oxford, who had paused their trial last month, are now showing robust immune responses in the elderly, which is very, very good news. But once again, it keeps the length of time people in hospitals down, it reduces deaths. So even if we haven't got a vaccine, if we've got something that can protect and shorten the burden on the healthcare system, that is very important for lockdowns. And at the same time, we do have 6 vaccines now that have been approved for limited use. So nothing final yet, and we are in November already, but 6 vaccines with limited use is certainly helping. And again, it's reducing the deaths and it's reducing the length of stay in hospitals, which is very important. So despite the risks, despite markets being down 5% last month on concerns that winter is coming, they have recovered in the last couple of days on the back of the US elections, number one, but also on the fact that Brexit has been kicked down the road once again, with the deadline being moved from mid-October to mid-November. So we breathe, there's more time that a deal can be done. And also Russia and OPEC Plus getting together and saying they're going to extend the supply cuts, which is positive for the oil price and positive for oil producers and commodities in general. So overall, despite the volatility we saw in October, we think this is just what it was, volatility. It's not changing the growth scenario. It's not changing our economic forecasts. It's just volatility in a market that has been volatile for a long time, and it's giving us opportunities to harness that volatility. So we're not surprised. In fact, we're using that volatility that we've been provided with. So on to the US elections. I'm sure you've all been watching very closely over the last 48 hours as we try to piece together what's happening. Is it Trump? Isn't Trump? Everyone's so scarred after the 2016 election, where everyone thought it was definitely going to be a Democrat victory, and then Trump stole the election. Oh, sorry, let's not use the word steal. That's a Trump word. He won the election in 2016. Now he claims that, frankly, we did win this election, and he is contesting the elections. But let's look at what the numbers are showing us as we speak. So despite Trump claiming that he is the victor, there is no winner yet. We sit at 264 for Biden versus 214 for Trump. You can see those numbers there. 270 electoral votes are required to win, so no one has quite won yet. Nevada is likely to push Biden through to be the winner, but we haven't got a confirmed result yet. What has happened is this election has seen all-time record high mail-in votes, and those weren't counted on the first day. So as a result, and for some reason, it seems that Democrats prefer early voting to the Republicans. So on the first day of voting and the first night at the polls, Trump certainly was winning. And that's why he came out at 2 a.m. in the US to claim the victory. And he said the polls are showing that Republicans have won, he has won, and he was setting the scene saying, I've won, anything else is going to be fraud, which was a very clever strategy. He's setting up optionality in case of those mail-in votes do go against him. And that's certainly what's happened. As those mail-in votes have trickled in, so Biden's margin has widened and widened. At one point, he was neck and neck with Trump, and that margin is widening quite nicely. However, it does give Trump room to attack what has happened, and he has done that. So he sought out a recount in Wisconsin. He's filed a suit to stop counting the mail-in votes in Michigan, and he's claimed that he's being cheated of the victory. So there is a chance that this could be contested, and we could see a delay. However, as the margin widens further and further, that probability is actually diminishing. So at the moment, despite Trump contesting and setting himself up for the fact that the mail-in votes have been rigged, despite that, where we're sitting right now, it looks like there's going to be a Biden victory, and it looks like that Trump won't be able to contest. And the markets are rallying very hard as a result. So what we're seeing overall is a purple US election. We've got a divided Congress, with the Senate remaining with the Republicans and the House remaining with the Democrats. And markets like purple. That means government inaction. And generally, the private sector thinks that the government doesn't make the right decisions. So when you have a government that's hamstrung, they can't break as much. And that means unchanged tax policy. It means much lighter touch on tech regulations. So overall, a far more muted impact on the private sector. At the same time, what could be seen as a negative is that it does mean reduced chances of fiscal support. The markets were getting quite excited about a blue wave with the Democrats holding the presidency and the House and the Senate, which would have allowed them to pass through rapid fiscal support measures, as well as rapid changes to regulations and taxes. But what the market is now reading out of this, and the market tends to find whatever it wants to at the time, but it's now reading that despite a lower chance of fiscal support, it just means that the Fed will have to carry the can, and they're expecting the Fed to have increased quantitative easing, much lower interest rates for longer, and monetary policy will carry the day instead of fiscal policy. What does that mean? It means a weaker dollar. It means search for carry continues, the search for yield. It's very positive for emerging markets, very positive in particular for emerging market bonds. So yeah, right now, we don't have a final answer, but the way it looks to be going, positive for markets, less impact from a regulatory and tax perspective, more monetary support, and just generally good for the dollar in terms of keeping the dollar weak. And from a global perspective, Biden being at the White House means far less abrasive foreign policy. He likes to coordinate, he likes to collaborate. So even if there are attacks on China, it's going to be done within the united frameworks of the United Nations, and would be a far more stepwise and incremental process, which again is just less disruptive for markets. So overall, quite a positive result from the US elections, and markets are running very strong today on the back of that. So the other positive news we've had is from China. And this here is the Chinese president saying, no blackmailing, blocking, or extreme pressure will work, targeting very much at the US. Is tired of being the scapegoat and being blamed for everything that's going wrong in the world, rightly or wrongly, but China is hitting back. And China is looking very, very strong at the moment. Top right-hand chart here shows global trade, global exports, and you can see emerging markets leading that rebound in trade and exports, and looking very strong back to previous highs of 2019, much faster rebound than advanced economies. And that's driven by a couple of things. But firstly, all the fiscal support that's being pumped into the markets to support COVID, a lot of that's done through infrastructure projects, investment in infrastructure, building bridges, railroads, airports, hospitals, whatever may be needed. And that's very good for commodity prices, very good for trade, very good for emerging markets. At the same time, ironically, work from home has been very good for manufacturing. It's led to very strong Asian exports in the electronics sector as a result of people working from home, buying new computers, new screens, printers, whatever it may be. There's been a surge in the electronics export sector from Asia. So generally, all looking very good for emerging markets. And China in particular, they have weathered the COVID-19 storm incredibly well. Not only were they early in and early out, but despite the restrictions on their mobility, their economy is pretty much back to 100% full mobility. So yes, there are very, very stringent restrictions, but it's not stopping their functionality in any way. And while the rest of the world fights about whether COVID is good or bad or right or wrong, and whether we should be wearing masks or shouldn't be wearing masks, China's just getting on with it and working hard. Yeah, I mean, you might not want to be working in China right now, but certainly it's working well for the economy as a whole. So we're seeing a strong China, strong emerging markets. The bottom right chart here is from Citibank. It's the Emerging Market Economic Surprise Index. You can see here that the blue line, 5-year highs, in fact, it's actually decade highs on that surprise index. Very positive news coming out of emerging markets, primarily driven by China, but all the emerging markets benefiting from the strong growth in export and trade. The green line shows MSCI EM equity, hasn't followed yet, but as you can see, there is some correlation, and we are likely to see strong rebound in emerging market equities as a result. So overall, we remain bullish on China in particular and the emerging market story, particularly because of the rebound in manufacturing and trade, export volumes, but also because of the strong demand for commodities, because of fiscal support that is very much cement and copper driven, also because working from home is driving the manufacturing, and as ironically, most developed markets are much more service orientated than manufacturing orientated, and services is the most hampered by COVID. You don't want to go for a physio treatment, or you don't want to engage other people in whatever it may be, because that's risky. But it's far easier to order a new TV online. That you can do. So certainly people are shifting their spend away from services to manufacturing. At the same time as fiscal support is driving infrastructure, which is very much like commodity strong. And now we've had the purple US elections with hopefully or probably Biden in the White House, which again is good for the dollar in terms of a weak dollar, good for global trade and policy, which generally is very supportive for emerging markets. So we are overweight emerging markets, and we are in the process of launching our MSCI EM50 ETF, and that should be ready in February next year. Okay, so the good news was China and emerging markets and the US elections. The bad news is, unfortunately, once again, South Africa. Tito, one of his many quotes at the medium-term budget policy statement, he quoted Madiba, he quoted Samuel Coleridge, he quoted the gospel according to John. Our job is not to tremble in fear at the storm blast. That's one of the very poetic things that Tito said, imploring us to have faith. And that's generally, unfortunately, Tito's main tool at the moment is faith. And it's not really a great investment strategy, and we are seeing a lot of investors externalizing their investments, worried about a failed state. And I do have a number of slides on that in particular, but let's just start with what happened. So we had President Ramaphosa's Economic Reconstruction and Recovery Plan, which was overall a great plan. Lots of promises, the promises we've seen over the last 2 years, unfortunately very short on details. In fact, the only detail that was the extension of the social relief distress grant, next 350 Rand per month for another 3 months, which unfortunately, along with SAA requiring another bailout, forced Tito to delay the medium-term budget speech by a week, so he could scramble and try and find finances to meet the extension of the social grants and to meet SAA's 10 billion bailout. So we had a delayed start, and Tito did his best to meet the ERR requirements within his framework, but unfortunately, he could not. So looking at the chart on the right, this is South African debt to GDP, it's a percentage on the horizontal axis, sorry, the vertical axis, and the horizontal axis gives us years. So the lowest line here was the 2019 budget, and there things were still looking quite good. Debt to GDP peaking below 60% for South Africa. Then we moved on to the 2020 budget, things not looking that fantastic, still much better than we are now. And then we had the special adjustment budget after COVID struck. And obviously COVID was very, very bad for budget as a whole. Tax revenues dried up completely, no tax on cigarettes or alcohol because they just weren't allowed to be bought and sold, and no tax revenues because no one was working. And the debt to GDP skyrocketed up to over 80%. At the special adjustment budget, Tito said, well, there's two options. We either become a failed state and move along this passive scenario, which is the dark line here, where debt to GDP skyrockets ahead of over 100%, causing a debt trap where you end up spending all your revenue on interest payments, or we take action and we move into the active scenario. Debt to GDP will peak at 87.4% in 2024. So, unfortunately, we moved on to October and the medium-term budget policy statements, and we have the grey line. Not as bad as the passive scenario, but unfortunately not as good as the active scenario. And the debt has exploded, and the peak in debt to GDP has moved out 2 years from 2024 to 2026, and it's now at 95.3% of GDP. Quite a scary number. But Tito is taking action, and assuming he takes the action, it means South Africa is on track to have debt start to diminish over the medium term. And Tito once again pointed out that the probability of a debt trap has increased. And the debt service costs are going to rise to 18.3% of spending. That's more than we spend on healthcare, and it's a waste. Absolute waste. But we are in the hole that we are, as is the rest of the world, because of COVID, and we need to cut costs. Unfortunately, because of the increase in debt, we are likely to see further credit rating downgrades either this month or next month, probably taking us from double B to single B across Fitch and Moody's and S&P. So what did Tito do? Well, he said, firstly, a good thing. He said South Africa's taxed to the hilt. The last increase, the tax increase they had, actually resulted in slower GDP growth and reduced, as a proportion, reduced tax collections, that we beyond the curve, we cannot increase tax any further. So there will be small increases in tax, probably leading to another 5 billion of tax revenue, but that amount can be done through excise duties or even backup creep. So we shouldn't see any massive changes to the tax regime, which is great. Compared to countries around the world, like the UK, where they are expecting to see huge amounts of tax increases to pay for the furloughs that are ongoing. And the US, with their massive twin deficits, should also see some tax increases. Yes, it might take a while for Biden to get that passed now that there's a divided Congress, but they certainly are going to try. So how's Tito structuring this? Well, he is cutting costs from expenditure, which is very good, and moving it, allocating that spend to investment, which is also very good. With the ratio of salaries to fixed asset investment in our budget is way out of global norms and what a country needs just to keep its asset base maintained, let alone to grow its asset base. Unfortunately, it does lead to high execution risk. And basically it requires the freeze in the wage bill that was set this year to continue, and a further freeze in the public sector wage bill for the next 3 years. Now, we already know that Labour is contesting this. They're already in the courts. And they have come out strongly to say that they disagree with this, as they have to. So we need to have faith that Tito can organize, that government is strong, and next year is an election year, that government is strong and ensures that the wage freezes are maintained. So obviously the rating agencies have come out to say very high execution risk, unlikely it can be done. But Tito has shown that the government is playing very hardball this year. And that, yes, they're in court, but while they're in court, those increases aren't going through. And if they can drag this out for long enough, the increases won't happen. So I think there is a relatively decent chance that the majority of those cuts can come through. And on the revenue side, we could see some surprises on the upside because of strong commodity prices and because of global growth recovering stronger than expected from COVID. But generally, South Africa in a tight space. And I understand why there is this concern about South Africa becoming a failed state. Well, I will get to that. So one of the solutions that has been thrown around to get growth back in South Africa is the infrastructure drive. I mean, we are looking at another World Cup 2010. If we can spend that sort of money, but on productive assets, not white elephants, but on productive assets, and the infrastructure projects that have been targeted look productive and look like they are certainly in need and will help the economy grow, then this is a very exciting time to be in South Africa and could lead to some very exciting growth and job creation. But so where are we? Unfortunately, we're nowhere yet. And this is probably going to take a lot longer than we hope and a lot longer than we want, and probably at least 3 months. The draft proposed changes to Reg 28 was supposed to be out mid-September. We still haven't seen the draft, let alone the final. Not that that holds us back, but even excluding that, just looking at the plans, there was an update on the 3rd of November in terms of the next steps forward, but we still are unlikely to see anything until January or February next year. So as I've said, infrastructure is vital to any country's growth, in particular South Africa. Normally, that's done through the government. Normally, a lot of the government spend is on infrastructure. And when you have a balanced budget and a well-run budget, then your tax revenue that comes in any one year is used to meet expenses, and your borrowings are used to meet future projects. So to that extent, South African government bonds really should be seen as infrastructure bonds, because the majority of those bonds should be used to build hospitals or roads or maybe. Right now it's not, because of the lack of tax revenues, and right now our bonds are being spent on covering interest costs and salaries. But I mean, ideally, South African bonds should be infrastructure bonds, but they're not. So what other ways can you access infrastructure? Well, there's a lot. State-owned enterprises, Eskom, Sanral, Gaini, AXA, Denel, all have very strong, or not strong, but very large cash requirements and very large debt programs, which are easily accessed. And Sygnia funds do have specific access to, or investments in some of those. But the chart on the right shows credit spreads over the last year for various sectors. And the light gray you can see is SOEs. And as the government risk of default has increased, as Eskom has moved closer to default, as Landbank has defaulted, as SAA has defaulted, as Denel is close to default, so those risks has increased, and so the spreads have widened. And they do offer some good investment opportunities, and you can get these yields for, in some cases, bonds which have government guarantees. So you're getting a decent yield of 200 points over JIBAR with actually no additional risk. But anyway, the problem is that, rightly or wrongly, in 2016, Future Growth came out and said that investing in SOEs is a bad idea, that SOEs are not well run, and they are going to go bankrupt, and people will lose their investment, and they stopped supporting the SOEs. So the SOEs have much diminished cash availability, and so they're battling to just do maintenance, let alone new growth and new projects. So what's happened is we started off with South African government bonds. No one wants to buy those, so you can see the yield curve is as steep as it's been because of risks that are happening there. So you move into SOEs, but those haven't been well managed. People aren't supporting that. Credit spreads are blowing out, it becomes incredibly expensive. So the government has now moved on to stage 3, which is partnership with the private sector and pension funds, provident funds, to start infrastructure investments at a project level. Far increased levels of governance, far increased levels of transparency, all packaged to the DBSA. And this really should, again, it's execution risk, but it really should, if done well, allow us to catch up on the backlog and meet the country's infrastructure needs. And Sygnia is well positioned to invest in those projects as they come along. But as I've said, early days, but very positive in general, and good for your pension funds in terms of attractive yields with low risk, and at the same time, good for the country in terms of getting the much needed infrastructure in place. Okay, so that's a summary of the various markets where we are. Europe looking a bit scary because of winter and the lockdowns. The US looking good because of the purple elections and probably Biden in charge. China and emerging markets look very strong, driven by fiscal support, which is very commodity intensive, and people shifting away from services to manufacturing, and also a weaker dollar because of Biden. South Africa, a lot of concerns. Debt levels are exploding, with the light at the far end of the tunnel from infrastructure. So what does this all mean for how we're positioning our funds and investment allocations? So a controversial statement, but we've had a lot of concern, people saying, you know, that South African assets or equities haven't grown over the last decade, and developed markets have. South Africa is a failed state. We want the returns that everyone else is getting in developed markets. We want to sell all our SA assets and we want to put them in developed markets. Understandable. There is risk within South Africa, and we have missed out by being here. But I think it's very important to say that South Africa is not a failed state. We are an emerging market. Now, you could debate whether all the emerging markets are failed states to some extent, because they certainly are not developed markets. But we are an emerging market alongside China, Brazil, India, Russia, and the rest. And these charts show that. So the top right-hand chart shows the rand. So the white line here is the South African rand. This is over the last decade, starting at 100. So you can see the rand's lost 45% of its value over the last decade. Not a great story. But emerging market, this is the JP Morgan basket of emerging markets, has also lost 45% of its value. So we haven't lost any more or less. Yes, because we're the most liquid emerging market, there is some volatility. You can see the white line a bit more volatile than the orange line. But in general, we are an emerging market. We're not a failed state according to the rand versus other emerging market currencies. The green line shows our terms of trade, and that's where things are looking quite exciting. Very strong movement this year. The copper price has gone up, we export copper. Iron ore price has gone up, we export iron ore. Platinum and gold prices have gone up, we export all of those. At the same time, oil prices have come down and are likely to stay down for quite some time as people start working from home more and traveling less, and the new normal sets in. So our terms of trade could stay positive for quite some time, which is very good. And we need to remember that we're a small open economy. And yes, corruption has hurt us, certainly. I think we've lost the numbers, get varied all over the place, but over a trillion rand from corruption. It's terrible. But we are a small open economy. We are 40% of our markets are owned by foreigners. We're highly dependent on global trade. So when China goes up, we follow them. We're highly dependent on commodity prices. And this chart shows just that. So what about our equity market? And that kind of shows the same thing. So the gold line is the Johannesburg All Share Index. The white line is the MSCI Emerging Market Index. And over the last decade, again, starting at 100, track each other very, very closely. We have diverged in the last 6 months. That's been very much driven by China. So China is decoupled from emerging markets because of their resilience to COVID, and because of their 100% full mobility, the fact that their growth is back to normal, back to pre-COVID levels, and because they are handling COVID so well, unlike the rest of the world, they have decoupled. So, barring that exception with China, South Africa, once again, our market is moving in line with the emerging markets. Yes, if you look here in particular, sorry, so the white line, again, that's emerging markets. The green line is emerging markets ex-China, and the yellow line is South Africa. So there is a gap that's opened up relative to other emerging markets over the last 6 months. But that is showing extreme value. And we are seeing a number of South African asset managers going overweight SA equities. Prudential had a webinar yesterday. They said that South African equities are the cheapest they've been in 100 years. Now, I don't even know if we have data that's older than 100 years. So I would say South African equities are the cheapest they have ever been. And yes, there are risks, but when you have an asset class that's the cheapest it's been in 100 years, you need to think twice about completely selling out and investing elsewhere. And the problem with investing elsewhere is it brings on the question as, well, where? Yes, it's an easy decision to say, I want to sell Rand and I want to move my money offshore, I want to sell South African bonds, I want to sell South African equities, but where do you invest? Do you invest in Japanese bonds at 0? Do you invest in German bonds at -0.5%, US bonds at 0? And that then forces you to look at the alternatives, and alternatives don't look that exciting. So why do we get this feeling that we've missed out over the last decade? Why do we feel like we should be, South Africa is a failed state and we would have done better elsewhere? It's driven by two things, and they are linked: tech and the dollar. So it's not really just a developed market, emerging market, or a developed market South Africa story. It's very much a tech and dollar story. In particular, let's look at tech. So the last decade has been dominated by tech, and trade wars over the last 2 years ago, and COVID over the last 6 months have accelerated that move into tech. So the chart here, top right, the bottom there is developed markets. So it's Europe, it's UK, it's Japan, gold, global bonds, emerging markets in South Africa. You can see that, yes, there's dispersion, but all pretty close. Then you look at the top blue line here, that's the NASDAQ. Nearly 6-7 times the return that the rest of the basket has had, and that's dragged up the US. So the US has been the best performer of the last decade, but because of the tech sector. If you look at the US ex-tech, they're also down here. Our fourth industrial revolution fund is also down here, and that's because this tech story is not just tech. It's an incredibly narrowly driven tech performance. In fact, there are only 6 stocks that have driven this entire performance. If you look down at the bottom right, this is from JP Morgan, they call it big tech, 6 stocks. You know them: Apple, Amazon, Google. Those 6 stocks make up nearly 45% of the S&P. And their valuations are looking quite extreme. So why have you missed out over the last decade? 6 stocks. If you had 6 stocks, you'd have done phenomenally well. If you had the rest of the US, Japan, Europe, UK, emerging markets, South Africa, definitely there's dispersions, but you wouldn't have this huge feeling of this massive disparity that's going on out there. So when you want to consider the changes, well, what do you do? If you buy in the US now, you are basically buying these 6 stocks, unless you invest in fourth IRA, which is equally weighted, and why we prefer that investment. Those 6 stocks have a lot of risk, antitrust risks. Even Trump has already filed an antitrust suit against Google. So even if Biden wins and it's a divided Congress, there seems to be some strong consensus that antitrust issues will go forward. There's privacy issues across all of them: Facebook, Google, there's tax. A lot of those companies are paying half the tax that other companies are. When the US has huge deficits, twin deficits, 20% deficits, they need tax revenue, and they're going to be searching for tax. And the easy pickings are the big 6 companies. So look to see that happen. And valuations. The S&P is pricing in 3 times the earnings growth of South Africa in perpetuity, forever. So if you're convinced that South Africa is going to earn a third, or its earnings are going to grow at a third of the rate of the S&P forever, then at this point you can switch into the S&P. But remember, if you look over the last 40 years, South Africa has had stronger earnings growth than the US. And one of the reasons for that is the fact that we have less competition. When things are tough like they are now, the small guys unfortunately lose market share. It's very sad. The big companies, the independents fall over, and the big companies gobble up that market share, and they grow market share. And foreigners don't want to touch South Africa. So you almost end up with oligopolies, monopolies, which survive in bad times and thrive in good times. So that's the one issue, tech. That's what's made us have this feeling of missing out over the last decade if you hadn't had a large weight to those 6 stocks. And the other issue is the dollar. So again, the dollar is a safe haven. Top right-hand chart shows the dollar weakened over 2000 when commodities were doing well, emerging markets were doing well, China was doing well. And over the last 10 years, the dollar has been very strong. So the last decade, we've had a strong dollar scenario, which has hurt emerging markets. Because emerging markets price most of their debt in dollars. Strong dollar, high US interest rates means it costs a lot to borrow money. And it makes liquidity very tight. Now we're seeing weak dollar and low US interest rates, which makes liquidity quite abundant. So once again, trade wars and COVID, both risk-off scenarios, push the dollar higher. But the dollar does tend to move in 9-year cycles. And that's, you can go back over 100 years. So we are likely coming to an end point in the strong dollar. Obviously, you need a catalyst. So what is a catalyst? Well, one could be Biden. Far more peaceful and coordinated global policy means that the rest of the world growth is not going to be hampered. So strong rest of the world growth is positive. Lower oil prices are also change the US dynamic. It means US has to import more, export less, which again leads to a weaker dollar. At the same time, we've got very strong, for the first time in a long time, very strong fiscal support, which is again good for commodities, good for manufacturing, good for emerging markets, which and good for a weaker dollar. And then longer term, the bottom right chart, which I have shown before, but just to show that there's such strong population growth coming through in Asia, particularly Asia ex-Japan, and that population growth and expansion of the middle class leads to increased spending, leads to stronger GDP, and that's going to lead to an eclipse of the US from currently the strongest or biggest economy in the world, the second strongest, but also Europe falls by the wayside, and Asia ends up having 4 of the top 5 slots in the largest countries by GDP, and excluding Japan, that's emerging markets. So we are going to expect strong growth. China is handling COVID well. Trade and exports are doing a lot better than expected. Decade high economic surprises. So all of this supports our view for being underweight the US and overweight emerging markets. So again, the strong dollar has been one of the reasons why the US has been the place to be over the last decade. Strong tech has been one of the reasons why the US has been the place to be over the last decade. And going forward, we think that is likely to change, the catalyst being COVID and Biden and fiscal support. So what does that mean for our return and risk assumptions? This is a bit of a stylized chart, so please bear with me. The vertical axis is our real return assumptions. And there you can see that emerging market equities and South African equities, we're expecting better returns than developed market equities because of the fact that the US makes up 66% of the developed market, MSCI developed market, and the US is looking incredibly expensive right now. And we aren't, with the twin deficits and a divided Congress, we're not going to see fiscal support come through there. We may see some sort of tax increases come through over time. And generally with a weaker dollar as well, that's negative. So we are expecting weaker returns from developed markets, stronger returns from emerging markets. South Africa bonds here, very strong returns expected from that because the yield curve is so steep right now. Inflation linkers slightly less because there is a lot of risk priced into nominal bonds. SA income and SA cash not doing as well because of the low interest rates. The two asset classes we don't hold any of, South African property, still a lot of risk on that. South African property has been driven primarily through the shopping centres, and that is something that's certainly, we're not going to see any growth in that, and there's still a lot of excess supply. We've seen Edgar's shut down, a lot of the independents shut down, and supply is going to take a long time to balance out the demand on this property side. International bonds, again, we don't have any international bonds. Distorted by quantitative easing, we don't have any gold for the same reason, which is linked to developed market bonds. So no Japanese bonds at 0% yields, no German bonds at negative yields, no US bonds at close to zero yields. So international bonds at blue and SA property, we don't have any of. Overweight SA bonds, overweight EM, neutral the rest. International cash is an interesting one here. You can see I've got it on the negative side as a negative risk. So risk increases from low risk to high risk. International cash, despite the fact we are expecting the rand to continue to strengthen, we're now at below 16. Can you believe it? 1970, I think, was a peak a few months ago, and that's dropped to below 16. So our funds have done very well. As I mentioned, we underweight South African equities. We underweight the South African rand, despite believing it's not a failed state. We acknowledge there are risks, and we have been underweight. But we have had protection. So with the rand strengthening, our funds haven't been hurt by that rand strength. So that's very important to blend your views with the protection. But international cash is an interesting one. So I said we are overweight international cash, but with a hedge, because when things go pear-shaped, when a risk is turned off, well, international cash actually makes you money as the rand weakens. So that's why this is on the negative side, because it's negatively correlated. International bonds, unfortunately, aren't giving you that same protection. So this is our view on the various asset classes. But most importantly, what does that mean? So if you throw that all into an optimizer and you run 2 million scenarios and you try and get an ideal understanding of how much money you should have locally and how much money you should have offshore over the long term, the optimizers spit out between 20 to 30%. So that remains the optimal long-term allocation. Not 50%, not 100%. So, there are reasons why you might want to take money offshore. You might want to take a small amount to hedge certain expenses. You might want to invest a certain amount of money in developed markets for certain expenses. But generally, living in South Africa with your liabilities in rands, it is certainly better to have no more than 30% of your investment offshore. And we saw why. October, global equities giving you -6% because the rand was so strong. This month again, a strong rand. The rand is very cyclical, but it's also it's driven by global liquidity, and it's not just about South African issues. So we need to remind ourselves that we are in emerging markets. Yes, maybe you want to take some exposure from South African assets and put that into emerging market assets as a proxy. That's fine. And in fact, when it comes to selling South Africa, I would think the only place right now that's giving you similar returns at maybe a reduced, if not a similar risk, is emerging markets. But then, you're just exchanging one set of risks for another set of risks. The MSCI EM has got a lot of state-owned enterprises in that, particularly in China. So it's certainly not risk-free. Yes, we think there's long-term growth, but there's also volatility. So not such an easy decision to say, take all my money offshore. And that is a wrap. Let's see if we have any questions. A question on the US twin deficit. Certainly their budget deficit and their trade deficit are looking very scary. There's definitely no room for increased stimulus. There is likely to be pressure, particularly now under Biden, for increased taxes to stop reducing some of that debt. Divided Congress will take time, but we do think that if you have to choose between increased stimulus and increased taxes, you're likely to lead more towards increased tax side. Question on Tito and Mboweni. Tito is doing a fantastic job. He really is. He's between a rock and a hard place. I think the budget he put together was really, really good. The only question about it is execution risk. Without execution risk, people wouldn't be concerned about it. The rating agencies wouldn't be concerned. It's realistic. It could surprise to the upside with increased tax revenues, but it does come with execution risk and key man risk. If we had to lose Tito, we're not sure who replaces him. He's got a very strong hand on process and ensuring that debt stays closer to the active scenario, not the passive scenario. So yes, one of my risks that I certainly do worry about is losing Tito and bringing in someone that doesn't have as good a balance on growth versus taking on too much debt. So there's some question that the screen share is not showing. That's okay. Sorry about that. So let me put that back on. Apologies. And go back to these charts. Do not know why that was not sharing. Okay. Okay. So I'm not sure where I lost you. This was 5 minutes ago. So, okay, this was the first chart to show the gold line is the emerging market currency index versus the rand in white. Basically, so that the rand is an emerging market currency, not a failed state. Likewise, looking at equities, when we have the reverse, you've got the all-share index in gold and the MSCI EM index in white. Again, they track each other over the last decade very closely, suggesting the same story. Then looking at tech, the light blue line is NASDAQ, which has pulled up the S&P 500. All the rest, S&P X Tech, Europe, UK, Japan, EM, South Africa, gold, bonds, all giving very similar returns. This bottom right-hand chart showing the very strong performance of the top 6 tech stocks compared to the rest of the S&P, so 6 stocks driving the S&P returns. And then looking again at the EM, weak dollar for most of the noughties, strong dollar for most of the last decade, and we're expecting a weaker dollar to move forward as the dollar moves in 9-year cycles, particularly driven by very strong emerging market growth, India, China, Indonesia popping through. and displacing the US as a growth driver. And then this chart showing the expected returns for the various asset classes. Dark green are where we overweight, emerging market equities and SA bonds. I've lost my spotlight here. SA property, so it's light blue, and international bonds where we underweight. The dark blue is where we're neutral. SA equity, international developed markets, linkers, SA cash, and you can see here we overweight international cash. But most importantly, the optimizer is showing that based on these returns that I've got here, and based on the fact that we do expect emerging markets to outperform developed markets over the next 3 years, at least, which will support SA, you want to have no more than 30% offshore. When South African bonds are giving you the highest returns in the world, real returns, when South African equities are looking cheapest they've looked in 100 years, you don't want to move too much into expensive asset classes. Again, there are risks. There are risks because of huge amounts of debt, but that huge amounts of debt applies everywhere. We're not the only ones who have to take on debt because of COVID. The US budget deficit is looking at close to 20% this year, compared to ours at 15–16%. So they've taken on more debt. UK has extended their furloughs. Germany has extended its support for its companies to the lockdown. We're unlikely to see a second wave here of lockdowns. We're unlikely to have to further support our companies, whereas Europe and the UK are going into a second round of fiscal support. So debt is something that's everywhere. The risks because of that debt are everywhere. So yes, things aren't looking great here, but the debt to GDP is a global phenomenon. We're now eclipsing World War II levels, and there's nowhere really to hide. We are going to see increases in tax, and we're lucky, in fact, in South Africa that we can, at this point in time, rely on the infrastructure drive and rely on the fact that there is some low-hanging fruit in terms of optimizing corruption to get growth started. Whereas the US and the UK and Europe, where they are well run, yes, they haven't missed out on the last decade like we have, but they certainly will need to increase taxes a lot more aggressively than we will need to. So the risk to South Africa, most of our debt is in rand, so we can't default. We can, unfortunately, just take on too much debt, which means that we end up with huge debt service costs. So the risk is that we move from the active scenario to the passive scenario, and Tito has to take on too much debt. Okay, so I presume you've all seen this screen enough, so let me stop the sharing. So the risk is that debt, and it's not a base case, but the worst case scenario is that the debt accelerates to over 100% of GDP, and you end up spending more and more of it on more and more of your tax revenue on interest costs. So if we get to that point, there's one of two ways of sorting it out. Either you do default, and I think that's an unlikely scenario because that will cause huge depreciation of depression. Economic growth will fall over a cliff. The other option is you start to do some sort of quantitative easing, like Japan is doing and the US is doing and Europe is doing, where, now I hope we don't have to get there, but it's the more likely scenario where the government starts to buy the bonds themselves, which caps the yield on the bonds and caps those expenses. As long as the government's paying itself, it leads to a complete mess, and certainly don't want to see that, but it's what's happening in the developed markets, how they're affording the huge amounts of debt, so they're just buying it back. So the worst case scenario is we start to see some sort of QE happening in South Africa so that we can afford the interest payments. But let's hope we don't get there. But I think we have time. I do think we have time. for Tito to sort things out. Okay, so here the tricky question. So we are overweight South African bonds because of the yields being higher than anywhere else in the world, and because we think the rand certainly getting closer to fair values now. It's below 16, but when it was at 19, it was a no-brainer. But the rand could get down to 15 and a half quite easily, and so we're comfortable being overweight South African bonds and keeping our protection against rand strength on those portfolios. South African equities is a harder decision. And I understand why people want to take money offshore, and there are a lot of risks. So we are about 4% underweight South African equities relative to our benchmark. Despite the value that's there, we still have a good 40% in South African equities, so it's not low, but there are risks, and we are waiting for a catalyst. So one of the catalysts could be Biden winning. We're waiting for that to be confirmed, and certainly emerging markets this month and last month with our performance. And emerging markets are driven strongly by China, and China's handling COVID, so that's another reason. So you've got China and COVID, you've got as a positive catalyst, you've got the Democrats and Biden as a potential positive catalyst. But I think to get truly excited about South Africa and to at least go neutral, if not overweight, you need to wait for this infrastructure program to be in place. And that's 3 months away. It's not too far. But if we can see some concrete plans being put forward with the DBSA packaging the projects in a transparent manner and supplying liquidity. So the big issue is liquidity. And right now, there are opportunities out there. We have had opportunities to invest in 2 projects. One's a 20-year water bond, and the other one is a 20-year wind farm. But it's a bilateral loan agreement. So firstly, it's a loan, so you can't put it in your trust. You have to put it into life license. And secondly, it's bilateral, which means that if we have outflows, you cannot sell it to anybody. You cannot trade a bilateral loan agreement. So it's just yes, pension funds have a long-term outlook, but you lose clients, you win clients. You need the flexibility to be able to move those investments from one client to another client. You can't do that with a loan agreement. So there's a lot of questions that need to be answered. How do you fund the development phase where there's a lot of risk? It takes 2 years or 3 years to build the project relative to the harnessing phase where you open the toll road and you get the cash flows. And so a lot of questions, a lot of risks, but we're waiting if we at least get some clarity on how it's going to happen within the next 3 months. That to me is probably the biggest catalyst. But right now, as per usual, it's more wait and see. Implementation is key. And certainly we are seeing things improve at South Africa. You can't deny it. Yes, things aren't where they want to be, but Eskom, things are turning around. We are seeing changes to privatization of usage of private power suppliers, as well as being forced to use Eskom. We have seen managers being fired from power plants. Eskom has taken property as collateral. So there's a lot happening slowly, but there is stuff happening. So we're seeing catalysts, just not quite enough yet. Emerging market tech sector, yes, so that's not nearly as overvalued as the US tech sector, so we do like that. Alibaba, Tencent, Naspers, we are big believers in Naspers. Naspers is sitting at a 50% discount to Tencent. We like Tencent. And that's another reason why we are not as concerned about our South African equity exposure, because we do follow the SWIX, which is 30% Naspers, Process, Tencent. So there is a lot more protection. It's COVID defensive. It's exposed to Chinese growth. It's exposed to the tech sector, and it's not nearly as expensive as US tech stocks. Sorry, the Wi-Fi dropped off for a second there. And where were we on the questions? Okay, another very good question. 30% offshore. How do you spread it? So again, it's the question of, well, and I hear this all the time from my friends. I'm worried about South Africa. I want to immigrate. Where do I go? Australia, Canada, Europe. Same thing with your investment. Worried about South Africa. Well, where do I put my money? As I said, Japanese bonds, German bonds, US bonds, all very constrained by or distorted by QE. If you want a basket, well, the global basket is roughly 70% US dollars, 30% euros, and that's on a proxy. But maybe if you can try and get some exposure to China, that's certainly, we like emerging markets and we like China. Yes, again, lots of risks, and they've got shadow debt, and there's SOEs are controlled by the government. The ghost towns, nowhere is perfect, but we certainly do expect the renminbi to be a beneficiary of all of this, and it has. If you look over the last month, the renminbi is doing really well. But lowest risk is a basket in line with global cash. Global cash is roughly, if you look at reserve currencies, roughly 70% US, 30% euros. But I expect that to change to include renminbi quite aggressively. Yeah, Brexit is certainly offering value. If you look at the UK, it's been a far worse performer than South Africa. Even when the rand was weak, and the pound is recovered somewhat, but the FTSE 100 is a terrible performer. So that's offering opportunities. Certainly there are risks, but we could find out, and again, it's a toss of a coin, but the most likely story is they will once again delay, give themselves more time, another extension, and certainly if there's an extension, then that could give markets a breather, and UK could run a bit further from where they are right now. Okay, so just to reinforce the preferred asset classes, yes, SA bonds we like. That is available in unit trusts. We have an all bond unit trust, and we have an enhanced bond unit trust. So that's the best way to get exposure to that. There is a webinar available on our website that you can watch if you want more details, giving between roughly 9.5 and 10. But I think it's between 10 and 10.5% yields right now. Phenomenal yields. So if you can afford a bit of volatility, that's a place to be. Globally, because of the valuations and the risk associated with the 6 stocks, we do prefer fourth R to FANG. Yes, FANG has got Baidu and Alibaba, so there is some non-US, and it has got some smaller stocks like Twitter and Tesla, but generally we prefer fourth R right now. It's 400 stocks, equally weighted, very well diversified, giving you strong market share growth, but not very small exposures. 2% to Apple, 2% to Amazon, 2% to the big 6 stocks out there. So a question on there has been a new tax directive. We are still trying to find finality on that. At the moment, it says that ETFs are seen as, so inward listed ETFs, so our ITRIX funds are seen as domestic investments. And so you can have unlimited exposure to that within your pension fund. We are checking in with the FSCA because that does sound a bit unprudent. As I've said, we don't think you need more than 30% offshore, maybe at a push 40, but certainly not 100%. And so watch that space. There should be a further clarity on that coming up. Yes, unfortunately, the Sygnia ITRIX Emerging Markets ETF is not ready. It should be ready January, February next year. We're very excited about that. Infrastructure projects should be, again, hopefully Feb next year. That was the last time frame I saw for more details, but that's in terms of project plan, unlikely to see access to investments till probably mid next year. And that's about it for the questions. So sorry about this dropping the screen. I hope you guys managed to catch on to everything I was saying. Have a great month. Happy November, and I'll see you all first week of December. Cheers.